Okay, hey, welcome back everybody to today's Market Explained with FourStar, a FourStar media experience. I'm Brian Kasal, your host, and I have my co-host, Mr. Chris Reardon here. Chris, welcome.
Thanks, Brian. Glad to be here. Glad to talk a little bit about the markets and what's going on out there.
And here we are for our regular update. Chris is the Director of Development at FourStar, and he runs our portfolios. He runs development with all the different product lines, does incredible work for FourStar. He's also the father of three young kids. Wow. And he's from Cleveland, so he still likes the Indians. I call them the Indians. But anyway, welcome, Chris.
Yeah, thank you very much. Like I said, glad to be here and yeah, glad to talk about what's going on.
Thanks, Chris. And I'm Brian Castle, your host and the CEO and founder of FourStar Wealth Advisors. I'm an advisor to insiders and CEOs of companies and lots of very high net worth investors. I'm the husband to the amazing Tripty and father to two wonderful young men, Evan and Quinn. So, folks, if you could give us a 5 out of 5 ranking when you go on Apple iTunes, you could always punch the the ranking system and give us a 5 out of 5. The more we do, the better we do. The better our rankings are, the better we get ranked, and then other people see us. We're still one of the top 1% podcasts in the financial industry, and we want to stay that way and keep growing. So thanks for being with us. So Chris, let's first talking about the markets in general, and then we'll talk about the economy, and then we'll talk about other really interesting things that we see out there that people should care about in the commerce world. So Chris, what do the markets look like now?
Yeah, so from a asset allocation perspective, it's actually been relatively quiet since our last podcast. So domestic equities is still leading the way. It's in that number one position, 284 tally points, and it was unchanged. International equities still holding that number two position. It has been slowly closing that gap, but it has been unchanged since our last podcast. So it's at 277 tally points. So kind of right there. They're very close. We could see an overtake there, but we haven't seen that yet. Commodities is in the third position. It's at 231 tally points, and that's unchanged since the last podcast. Cash is at 117 tally points in the fourth position. That's -1. That's the only change we had, actually. So -1 tally points from the last podcast. Currencies is in fifth at 94 tally points, unchanged, and fixed income is in last still at 86 tally points, unchanged as well. So, relatively tepid. Obviously, we did have that kind of shortened holiday Thanksgiving week in between. So that does, you tend to see things slow down a little bit there. So been kind of in this a little bit of a lull, I would say, back and forth the last kind of week and a half, 2 weeks.
So, Chris, I see you have the S&P ranked since we last talked up about 2%, 2.4, but the equal weight is up 4.4. So, if that's the case, that means the tech stocks have been a little sloppy since our last show, right? Those are the big dominant names in the S&P.
Yeah. I mean, the big tech names certainly have been. I think tech as a whole, though. I mean, the last time we had a podcast, we were kind of right in the doldrums of a big tech pullback that we were really seeing. Kind of that there was a lot of contemplation at that time. If this AI rally was for real, things like that. So, from a broad perspective, I think tech still has kind of gained from that, kind of rebounded a little bit from that bottom. But certainly, the Mag 7, the top 10, 15 names that really dominate that S&P 500 have certainly lagged the general, general market, which is more kind of the S&P 500 equal weight. Since each one is equally weighted, obviously, it's going to give you a little bit better idea as far as what the broader market's doing instead of, a handful of stocks.
Yes. Oh, good. Well, what about sectors?
Yeah, so interesting here. So we have a new number one sector. So communications moved up 2 positions. So it was in the third position. It moved to the best performing sector. It's up 23.83% year to date. And that's a 7.4% move upwards gain from the last podcast. Information and technology still held that number two position. It's at 21.69%, up 3.58% since the last podcast. So you can really see that the big moves there. And once again, if you guys remember our last podcast, we were talking about almost 6% pullbacks within communications and info and tech. So, this is kind of a bit of a rebound from that. Utilities, which previously, as we said, when we had that pullback, overtook as the number one position, it's now dropped down to the third position. And it was up 19.14%. And it was the only sector in the last couple of weeks that was actually, looking at it in that time frame was down. It was down 2.02%. So we actually saw a negative move there. And then rounding out, we have industrials in the fourth. That was up 16.73%. And that was almost a little over a 3% gain since the last podcast. And healthcare, which I think has just been a tremendous story. At one point, we had healthcare was the only negative name in negative sector. Has come all the way back up and is up 15.48%, up 2.72. So it kind of continues that momentum upwards. So I think that's great to see. Switching to the worst performing sectors at the bottom, the worst performing now is consumer staples, and that is up 3.81%. So it's gained 3%, and we have no negative sectors as of right now, year to date. But so it's gained 3% there. Number 10 is real estate. That's up 4.29%. That gained 1%. So outside of the negative utilities move, that was the second slowest as far as the last 2 weeks trending sector. And then consumer discretionary. And this was an interesting one to see because this was the worst performer. It gained 6.31%. It was the second biggest gain week to over the last couple of weeks, and it's up 5.60%. So interesting moves here. Rounding out, I guess, if we're covering all the sectors, energy is the next up there. That's up 8.40. Materials is up 9.54, and financials is kind of right in the middle at 11.05%. So interesting. We're still seeing a lot of jostling back and forth. Definitely a lot of volatility, both upwards and downwards. And we've certainly seen that in technology. As I said, the last podcast, we were kind of right in, I don't say a crash, but definitely a big pullback within technology. And then obviously, fast forwarding to this podcast, and we've seen a bit of a rebound. So it's kind of come full circle right now.
Yeah, it's interesting, Chris. The one sector that was negative, consumer discretionary, had a huge bump. And if that's happening, that means restaurants and cruise lines and all the discretionary spending that folks don't do in a bad economy. So maybe that means confidence is coming back again. And maybe that means that that's a signal that maybe if we are going to have a recession, maybe we don't, or maybe we have one that's going to be very light. So that's a good sign, at least for the economy.
Yeah, it'll be interesting to see. I think, and we'll get into this a little bit more from the economic numbers, but definitely seeing some slowdown here. And we kind of thought that was going to be coming down the pipeline. I think the biggest question mark is how steep will it be? How negative will it be? Will it just be kind of a little dip, or will it be more significant? But I think as of right now, that's good to see consumer discretionary spending going up.
Well, and then with the technology names not doing as well, and then the utilities going down, the utilities were the proxy for the energy that's required for AI. So now that's coming back down to life a little bit. So, maybe we're seeing either a slowing in that trend or certainly a breather, if nothing. That's interesting. And then the healthcare stocks were in the tank. Recently, they've had a big run, and they're in the top 5, which is really another interesting trend. And we started to see healthcare stocks in some of our other work as well. In the portfolios that we run, we're starting to position some healthcare names. So those are the things that happen in a bull market. Even though, we're up at a certain level, there's a lot of movement inside the index, right? And so that's what we're seeing now. We're seeing utilities fading a little bit, healthcare gaining, consumer discretionary gaining. And the nice thing, as you said, that there are no negative sectors. So it's pretty much a bull market across the board. And let's hope it stays that way. Let's hope there's no recession, or if there is one, it's a mild one. Most of the analysts are predicting that we will not have a negative quarter in the fourth quarter. So then it would be up to the first and second quarters to be negative if we're really going to see this economy slow down. And there's a good chance that doesn't happen. So we've been saying that all year, that there's a decent chance that even though there's a slowdown, there's not a recession. And I think the odds are getting stronger and stronger that there's no formal recession, which is 2 quarters in a row of negative growth. We haven't seen 2 quarters in a row of negative growth since 2022.
Mhm.
Brian Kasal. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. So
Yeah, I mean,
uh,
it'll definitely be interesting. I mean, I think right now, like the last podcast, I think we were just, I believe it was right when they were negotiating, they were kind of finalizing the shutdown. I think if everything went, which it did, everything went to plan, the shutdown was going to end either that day or the next day. So, we're starting to get some of this backlog of data that's coming out now, which, is certainly painting an interesting picture from especially the labor market data, which is definitely driving the market today. So, really interesting, and we'll see. I think it'll be really interesting, especially from the manufacturing perspective, how the tariffs play into that. There's a lot of factors at play.
yes. So looking at the other general market comments, Chris, I see that we're seeing the market multiples, staying at high levels at 23 times earnings. But yet, if you look under the hood and say, what if we did a multiple of all the stocks on an equal weighted basis? The equal weighted basis multiple is only about 18 times. So a lot of people are saying, gee, this market's way overpriced and this and that. But yes, the tech stocks are way overpriced, with certain stocks are trading at 100 or 200 times earnings, Palantir and NVIDIA and all these other names. But the average stock is not wildly overpriced, with 17 is fair value on the market. And the market gets less than 17 times and is considered to be a good value. So we're basically right around fair value if we're 18 times and not wildly overpriced. So I just wanted to point that out. Um, and also we're seeing consolidations of mergers and acquisitions like we haven't seen in a long time. Since beginning of Trump 2.0, there have been 63 deals announced of over 10 billion or more. So big deals of companies merging, combining, big real estate companies combining, a bunch of others combining. So that's also kind of fueling the growth in the economy. And those are good signs. Long term, creating efficiencies, lowering costs, better earnings, then that should lead to better markets as well. Chris, you have any market theme issues?
Yeah, I mean, I think right now, what's really driving the market is next week the Fed is going to make their decision on whether to cut, and that it's really, as much as it shouldn't be, it's really impacting the markets as far as whether they will. I think it's kind of back and forth. Today we're seeing a bit of a rally just because some of the recent data that came out, some of the ADP private jobs numbers, which I'll talk about in a moment, were less rosy than expected, if you will. They were showing weakening there. And obviously, if the economy is weakening a little bit more, that probably ups the chance that the Fed will most likely cut. So there's a lot right now that's volatility wise kind of playing out as data is getting kind of dripped and caught up from the government closure. And then the other thing I'll kind of say to your point with this AI, these multiples is um, there's a lot of considerations to be made with this AI and all these multiples. And actually, we're starting to see one of them play out. And the fact that these companies um, they don't operate in a silo. So even if AI is working, even if everything's optimal, they are still have to rely on other companies and other products and other materials. We talked at one point, we talked in the beginning about utilities, and that's going to be a major shortfall. A lot of AI companies are, trying to sign deals with nuclear power plants, things like that. But the newest kind of shortage is memory chips. So we're
Oh,
starting to see a lot of these AI companies go out and try to gobble up and take a lot of these memory chips. But as this shortage happens, as they can't, get enough memory chips, we're starting to see delays in AI projects. And not only that, these memory chips are used in smartphones, they're used in a lot of consumer electronics. So we could see this even ripple out into the general consumer market as well. So it's something really, important to keep in mind, especially with this AI, is even if, hey, their AI models are hitting, everything's great, um, things could still be out of their control to a degree. So, there's a lot of, I think there's a lot of potential out there, especially with the AI. I think that the other aspect of that, though, is, there's things to gain from that, right? Now we're going to see market entrance from the memory chips. We have the Microns, we have the Seagates, we have some of the main players there. But are we going to see, new market entrants there? That's the greatness of capitalism, right? Where there's an opportunity, you can have a smaller company come in, take some of that market share, where there's that shortfall.
Well, and HP is cutting 10% of its workforce based on that AI efficiencies. And we've talked about this on previous shows, Chris, that we are seeing a lot of efficiencies because they're able to use AI to handle some marketing work, legal work, all kinds of different things where they need language and words and that kind of thing. But we still haven't seen too many areas where now they've found applications that will help them grow earnings. They're reducing costs to grow earnings. That's a good thing. And then next step is how do we use AI to do better? And we're looking forward to seeing more and more that we haven't seen a lot, but we're looking forward to seeing that.
Yep.
So we'll see how that all goes with the memory chips and everything as we kind of work into this artificial intelligence world. Chris, one thing about the markets here in December, we're taping this today on December 3rd, and we're into tax loss selling season. So every year there's certain stocks that don't do well. And so if you are looking to limit your taxes and you've got some gains, you'd sell the stocks that are down, right? You take a loss to match the gain. But in a year like this, where the markets are all up big, we don't even have a negative sector, but there are negative stocks within those sectors, of course, for the year. So in a year when most stocks are higher, then the stocks that are down for the year, where you can take a tax loss, usually get hit even worse in December, as everybody's like, oh, it's the only stock I have I can sell. So they all sell this one name. Then we're seeing that happening now in certain names already. But at the same time, it's not going to go all the way till the end of December. So usually what happens is the selling is starting now over the next few weeks, but by about Christmas time in the 20s, that's when most of the selling stops and people get focused on holidays and the week between the holidays, and there's not as much activity. So the stocks that are down for the year usually get down more in this next 2 or 3 weeks. Then they bottom and start going up before the end of the year. So people say, oh, I'm going to wait till January. I'm going to find all the tax loss selling names. Well, they may already be rallying by January. So, if you're looking for names, I would look for tax loss selling names that you could buy if you're a buyer in the next 2 weeks and not wait till exactly the end of the year or wait till January because they may already be rallying. That's been the local trend lately. But rest assured, any name that you have in your portfolio that's down, there's a good chance it'll go lower here in December, even if the markets go higher, because everybody else is using it as a tax loss candidate.
Yeah, that's a good point. I mean, I think, and then to your point, once it gets to a point where the value there is just too high for people, then you see people start piling back into it, right?
Exactly.
Almost reversion to a mean, right? Going to go back to that normal trading range. So,
of course. All right, let's switch to the economy, Chris. What do we see there?
Yeah, so we're starting to finally get that backlog of economic data. So U.S. manufacturing slows. The ISM PMI, or Purchasing Manager Index, for the manufacturing slowed to 48.2 in November from 48.7 in October. And this was a pretty big miss, actually. The expectation was actually for a slight rise to 48.8. And obviously decline there. So anything below 50 is contraction. So the U.S. manufacturing continues to slow. We really haven't seen that kind of rebound and flatten out and move positive yet. The output of industry, so this is of U.S. industry, sorry, grew by 0.1% in September after falling 0.3% in August. The main driver of this, this growth in September was utilities, actually grew by 1.1%. So once again, seeing that utility sector, fed by the AI and all this innovation there. But that's interesting to see. And a lot of these numbers we're seeing are going to be September, things like that, because once again, it's this backlog from when the government shut down, in October. U.S. home prices increased 1.3% annually through September. That was a slight deceleration from the 1.5% annual number in August. So home prices continue to kind of slow a little bit as we have those mortgage rates that are still, still around 6.8%, I believe was at least in September. We know when these numbers are coming out. So and then the ADP private employer number. So this is what's really impacting the markets today. This, I believe, just came out today or yesterday. They showed a negative 32,000 or a shedding of 32,000 private payroll jobs in November. And that was after a gain of 47,000 jobs in October. So, a lot of people are pointing to this as, the beginning maybe of a slowdown. Obviously, it's just one number, but a slowing now maybe in the private labor market there. So we'll have to keep an eye on that. Retail sales increased 0.2% in September. That was slightly below estimates of 0.3%. So that's another one, to your point, Brian, that it's really important to keep an eye on as we get kind of caught up on more and more data, get that October and November numbers. But retail sales are definitely going to be very important. U.S. consumer confidence declined to 88.7 in November from 95.5 in October. So that was a big miss. Actually, expectations were a decline, but it declined to 93.2. So, consumer confidence definitely kind of pulling back as of late. Some of that could be the shutdown, things like that, but certainly impacting. And then the other big consumer sentiment survey is the University of Michigan's. That's the University of Michigan's consumer sentiment survey slid to 51 in November from 53.6 in October. So certainly, coming into through November, we saw kind of sentiment start to wane a little bit there. Once again, now with the government shutdown over, we'll see if that, trends back up or that trend continues. And then the last little bit kind of hits home a little bit. The Chicago Business Activity survey fell to 36.3 in November from 43.8 in October. The expectations were actually for a rise to 45.5. So that was a pretty big miss, once again, in our home city there, and below 50 is contraction. So, definitely from a manufacturing, it seems like we are starting to see a little bit of a slowdown there. The employment sector, I think certainly the expectation is we're going to continue to get negative numbers there in the labor market. So that'll be really interesting. Sentiment, I think, is going to follow that. But I think the biggest ones to watch, obviously, are, jobs, the labor market, and also retail sales, especially as we're obviously entering the holiday season. Are we going to see sales stronger than expectations?
Yeah. All right. Well, interesting numbers, Chris. I mean, we're seeing kind of green shoots come out, and then some things are coming back, and that output number wasn't good, but and neither was the sentiment number. But now we're seeing movements right now in the market that would say sentiment would probably be a little bit better, for December. So we'll see if that's true. Things are looking reasonable for the Christmas season now as well. It was initially expected to be negative. We're seeing better numbers for some of those trends as well. So that's what we see out there. We're also seeing discussions about whether there's going to be a rate cut in December. And more analysts are saying, well, maybe there doesn't need to be a rate cut. Everyone assumed there was going to be one. So if that happens and there is no rate cut, then that'll, keep the real estate markets a little jammed up. Probably they're waiting for a rate cut. A lot of folks are waiting for a rate cut, but there's also risk that there's inflation. Inflation stays stubbornly high. And so we're not sure what's going to happen there. Growth is stagnating, but it's not outrageous. But with stagnation and inflation, it's called stagflation. Anybody who was around in the 70s, remember they coined that phrase in the Jimmy Carter era, and that led to his ouster as president, actually, which is what happened. So, we'll see if the confidence does come back. We'll see how the Christmas season goes. We'll know in about a week and a half how that goes. And I think that's all we have in the economy, right, Chris?
Yeah, that's all I have from US, up to
Oh,
date as far as US economic data.
all right. In the international scene, the German economy is recovering, folks, and that's after a decade of stagnation, showing signs of revival, expecting 1.2% growth in the next 2 years. And yeah, that doesn't sound like much, but they've been negative growth for a while. And the European economies are pretty jammed up because they've been so socialistic for a long time. But they're now getting more and more countries that are run by capitalistic focused leaders, Ireland, Italy, Hungary, some of the others, and so we're starting to see some new policies in there. They can't fire employees, they can't readjust their workforces. A lot of things they can't do that have seeped into their rules and how they run companies in Europe, and so a lot of those basically just keep business from succeeding. Um, and so now hopefully those things change. Looks like they're changing a little bit in Germany. So we'll keep a
Yep.
watch on the international. Chris, you have some comments on the international
Yep.
markets now as well.
Yeah, I mean, I think to your point, the Eurozone composite PMI, which is kind of their manufacturing for the entire Eurozone, rose to 52.8 in November from 52.5 in October, and that marks its sixth consecutive month of increases. And I think some of the important things to highlight in here, Spain continued robust growth. It declined, I think, month to month slightly, but still was robust growth there. And Italy posted its strongest expansion since April of 2023. So I think to your point, Brian, we're really seeing, I think Spain's been kind of this unsung, as a here, but we really haven't seen Spain move much. I don't think in the last 10 years.
Right.
And it's actually been on quite a roll the last year. So that's good to see. Eurozone inflation rose to 2.2% in November from 2.1% in October. So that's important. Obviously, the ECB, European Central Bank's been cutting rates as well. So if we start to see that inflation tick up, is that going to slow that process a little bit? And then German consumer sentiment improved slightly. It posted negative 23.2, so still negative, but that was up from 24.1. And that was the November reading, beginning of November. So that
Well,
was
Chris, let me say that. So the German number you mentioned coincides with the German comments I had before as well. So it looks like sentiment is turning, economy's turning, right? Things
correct.
are looking a little better. And then, Spain was the sick man of Europe for a long time. And so they with, 25, 30% unemployment for periods of time when everyone else was in, low double digits or single digit unemployment, which wasn't good either. But, they were the worst ones. So it sounds like things are turning in Spain too.
Yeah, no, exactly. And I think, yeah, it's important to point out within Germany, the sentiment is improving there, I would say,
Right.
which
Right.
is good to see. So, and then
Well,
flipping it over to the kind of Asia Pacific, we had a couple things out of China. Rating Dog, which is a kind of a private survey company, they had a couple numbers. Their general services PMI for China fell to 52.1 in November from 52.6 in October. So that's the lowest level in the last 5 months. And so that continues. Anything above 50 obviously is expansion. So it still is an expansion technically, but it is continuing to fall. And then the same kind of private survey company, Rating Dog, they do a manufacturing PMI as well. And that fell to 49.9 in November from 50.6 in October. So that's important because once again, now it's moved below 50. It is essentially in contraction from expansion. So important there. And then China released their official PMI number, and that actually rose to 49.2 in November from 49 in October. So kind of interesting. Obviously, the Chinese number rising, but still lower overall than the private survey. And the interesting thing with the Chinese one is that that's the eighth consecutive month it's been in contraction or below 50 for their manufacturing. So a bunch of interesting things, I think. Obviously, keeping an eye on that, the tariff talks, things like that.
yeah. Okay, so let's turn to commodities.
Yeah, just a couple things to note here. Copper prices recently climbed to a record high, and this came after copper mining giant Glencore lowered its production target. So this spiked fears of tightening supply, things like that. Obviously, copper's huge with electronics, things like that. Obviously, electric vehicles, all that stuff. So that'll be interesting. We are seeing kind of a recent spike. And then keeping kind of with that US China, Shipments of U.S. crops to China are accelerating. This came after we had that tariff. China refused to buy U.S. soybeans. If you remember going back, I think probably maybe four podcasts, we talked about that they were willing to drop tariffs on a lot of U.S. goods, but they kept everything on soybeans. Well, they're letting off that a little bit here. We recently had 7 cargo vessels loaded, and they're headed to China for delivery. So they're buying U.S. soybeans, which is good to see. It's great for obviously U.S. farmers as well. So just those
Exactly.
2 notes from commodities.
Well, and the other really story in commodities lately is that silver and gold have been running like crazy, and we have big positions in silver and gold, and a lot of that has to do simply with the fact that we have so much debt in America. America was always considered to be the strongest economy, and we still are, but some people are getting a little concerned about our national debt. I can remember back in the year 2000 when we were working with a group called the Concord Coalition, that was a nonpartisan group trying to educate the public about the federal debt, and it was about 5 trillion back then, Chris. And everybody's like, "Oh boy, that was terrible." Well, now it's 38 trillion, and a lot happened. The most happened under the 8 years of the Obama administration, but Trump added some as well, and Biden added certainly a lot during the pandemic, and of course, before them, the Bush administration added some debt as well. So all presidents, all parties have been subject to this, and people are wondering, are we going to keep this debt level up? And that's why we're seeing now Bitcoin had a sell off. Now it's starting to rally again, and gold and silver are all-time highs. And that'll continue until we actually come up with some solution. Now, I have had some conversations with members of Congress about President Trump's comments about how he's going to pay down 10 trillion in debt. And I'm holding out for that, Chris, because Trump said in the campaign, let's pay down 10 trillion in debt. And the way they would do that, of course, is the estimates, depending on how you value things, are that the federal government owns 150 trillion of assets, whether it be communication leases, oil leases, land all over the world, other assets, buildings. I mean, anything. There's so much in assets the federal government has. All they would have to do is sell 10 trillion of those assets and then pay down debt. Wouldn't that be a good thing? And that would change everything. And then the dollar wouldn't be weak. So international stocks are up big this year. But if you look at it in their currency in Europe, for example, they're only up about 15% like our markets are. But in dollar terms, because the dollar has been weak by about 10%, it looks like they're up in our dollar terms 28, 30%, right? So sometimes when you have big gains in international stocks, all you have to do is look at the currency and you can tell what happened. And that's what's happened here again. So we could shore up the dollar, make our international creditors not worry about America, but we can't certainly keep adding debt at this rate and consider ourselves to be, an untouchable economy. Countries get so debt laden that at some point they just can't pay their interest. They'll actually cancel debt. That happened during World War II. And so we don't want to get anywhere near that. And so I really hope that President Trump continues with what he said, that he's going to pay down 10 trillion in debt. Member of Congress, Majority Whip Tom Emmer told me that they're probably not going to do it until after the midterm. So not for over a year. And it probably will only happen if the Republicans keep both the House and the Senate, because I don't think the other party would want to do that. So we'll see how things go, but I really hope they do that. And that's probably why the dollar is weak. And that's why the international stocks are up big. That's why gold and silver are up big in the commodity world. And Bitcoin has gone from what I paid 1,200 a unit about 6 years ago to over 125,000 units recently sold off, but now it's rallying again. A lot of these anti-currency things are happening because of our debt structure and where we stand in the world right now. So let's hope things get better. Anything else on commodities, Chris?
Yeah, I mean, it's certainly. I mean, I think the other thing that's, gold has certainly been 100% buoyed and
Right.
majorly driven by obviously our debt, but also, when the Federal Reserve lowers interest rates, the dollar tends to weaken. We're seeing the dollar weaken significantly today. Like I said, now with some of the recent economic numbers, the chance of a rate cut in December have gone up, whatever the market's doing now. So when we see that, we see the dollar weaken, gold tends to rise. So, we're seeing that play out as well. So certainly there's, a good backdrop there for precious metals, at least in the near future. I mean, hopefully we pay down that debt. Certainly needed. I know it's been one of the third rails, I feel like, to a degree of politics, though. Everyone wants to just
Mhm.
kick it down the line because $10 trillion. Do you really want to do it to pay off debt, or do you want to, take that money and hand it out to people or spend it on other things? Who knows?
Mhm.
But we'll see. Hopefully, I'm hopeful.
All right. So, in the general world, Chris, what do we see out there?
Yeah, so a couple interesting things. So Airbus, we've obviously the last, 7 years, I should say, Boeing's had its share of issues, and Airbus actually recently overtook Boeing as had the most production as far as sold plane. I think it's the A320 over the Boeing 737. But Airbus recently had problems of their own. They had to recall thousands of their A320s for software change. So this is causing them to delay delivery. So interesting, as we're seeing some jockeying back and forth between Airbus and Boeing. So we'll see if Boeing can take advantage of that now. It seems as Airbus is starting to have issues. Retailers are, this was interesting. Retailers are starting to move back into real estate properties. So retailers occupied 5.5 million more square feet
Mhm.
than they vacated in Q3 of 2025. So that kind of reversed a trend. And this trend is being led by discount retailers such as Dollar General, Dollar Tree, Aldi, Burlington stores, 7-Eleven. So, we're starting to see kind of the brick and mortar approach come back a little bit after years of internet and everything. And then the last bit, I thought this was really, really interesting. Waymo, which is I don't know if you're familiar with it, it's a autonomous kind of taxi cab you can take, and they have trials all over. I actually got to ride in one when I was in Phoenix, Scottsdale area, but they've been long kind of hyped as this overcautious drivers because it's obviously computer controlled. Well, they're starting to get a new personality, some people think, similar to New York cabbies. They're driving more aggressive. They're making illegal U-turns. And then at four-way stops, they're hitting the gas quickly so they don't have to wait their turn. So they said they're starting to adopt a little bit more of a aggressive personality to instead of this very cautious approach. So that will be interesting to see. I know some people like it, some people don't. Some people like it because if you were in like a San Francisco area, which utilizes Waymos as well, some people didn't like taking them because the trip would take longer because they would just be so cautious. Well, if they're being a lot more aggressive now and lane changing and things like that, people like that. So it'll be interesting to see if that that trend continues.
And they start crashing more if they're moving more aggressive. They start crashing. I was in Los Angeles, Chris. There were Waymos everywhere. I mean, they were kind of like dancing with each other. These Waymos on the street.
Oh yeah, I mean, and there was reports that I don't think I've seen one yet, at least recently with this that's hit a person, but there was one that hit a cat because it's moving so fast. So with
Yeah,
animals, it's so you're right.
doesn't
There's
see
gonna be
animals, right?
more potential incidents out there. So
Yeah.
just interesting developments there.
Well, speaking of cars, couple things. You can buy a car on Amazon now, Chris. Um, Amazon's in a big battle with Walmart, but one of the things they're doing now is they're offering cars on Amazon, and you can buy a car along with, a hair dryer and an $8 cable or whatever. You can buy a car, and so they're in a big battle back and forth. Now Walmart has been gaining share from Amazon in the online space, and they're trying out a new chat box with a dog named Sparky. So anybody who had a dog named Sparky when you were a kid, you could maybe see your old Sparky on the Walmart chat site.
Hmm.
So that'd be kind of interesting. Um, Also on the car front, um, the price of cars has gotten really out of control, and they're talking all about affordability now. That's like the latest political theme, and it's all about gaining and jockeying for position between the different parties, the Democrats and the Republicans. So the theme that one side is going with is affordability, and then the other side's trying to act like they're concerned about affordability as well. Well, the U.S. is investigating why cars cost so much, and they're coming to the point now in the U.S. Senate that they realize that there are a lot of the safety regs that they put in are ineffective. Like they added a regulation, the baby on board alarm and other sensors are ineffective. I know I had a fender bender accident, and just to fix the sensors and all the things in the back of the bumper, it was a $5,000 repair because there are more computers on a car there are really metal and plastic. It's just crazy. So anyway, America's shifting to larger and larger vehicles, maybe because they don't want to get into fender benders or they want to win when they have a fender bender. But they are going to be changing some of the regulations and reducing some of the regulation that will hopefully reduce the cost of building cars. So I thought that was kind of interesting. Um, and also, in the medical side, the U.S. negotiators are negotiating for the GLP drug, the weight loss drug, to become lower in price. And President Trump and some of the people in the Maha movement have been negotiating. Ozempic and some others have offered lower prices. And also, you used to have to go to kind of different clinics and places to get it. Now, most medical plans are allowing for that at lower prices. So the GLP drugs have helped a lot of people lose weight for sure. So that's happening. Another Maha update: Campbell's exec was fired for having a conversation that was recorded saying that they make high processed foods for poor people. And so that was kind of an admission that some of the food isn't as high quality, and they kind of know that. So RFK Jr., who's running the Health and Human Services Department, recently appointed Dr. Ralph Abraham, and he's a gentleman. He particularly doesn't like all the overemphasis on vaccines. Vaccines don't cause autism. That's what they're saying. Now they're questioning the worthiness of this health agency and all the things there. So they brought in people to solve many of those problems, including the bad food problem. Everyone's overweight, and that's part of the bad food problem. So a lot of those things are starting to take shape, and they're making some big changes. So one big change in our health is wine consumption is way down, Chris. I don't know if people have been following that, but the youth apparently, certainly in France and in Europe, prefer beer and spirits now. So France, of course, never met a government program they didn't like. So now they're paying people to stop making wine, and they're paying them to get rid of the vines in the fields. So if you're a maker of grappa, there's going to be a lot of vines to use. They use to make grappa is vines from winemaking. But anyway, um, the kids find wine somewhat complicated, and a full quarter of French adults under 25 do not drink at all. And the share of folks drinking the daily consumption has collapsed from in 1980, 51% of Europeans and a similar number of Americans said that they would drink every day. And that's down to 11% in Europe and about 15% in America. So we're seeing a lot of changes. There's also a change to making more natural wines. Now, they've been actually better in Europe than we have. We've had lots of sulfites and other things in our wine, and they're working on getting rid of those in America. But they've already gotten rid of that stuff over in Europe. But now they're taking a lot of these former wine fields and they're turning it into raising pomegranates, pistachios, peppercorns. We were in Morocco, which is just south of Europe, and there were pomegranates everywhere. So apparently, they must be doing the same thing in Morocco, because you couldn't walk down an aisle in the fair and not see a pomegranate stand. Anyway, so the world's changing a lot. The kids aren't drinking as much. Maybe that's smart. The Younger Union, which is the young people, younger meaning youth, right? In Germany, is advocating to reduce pensions as well. Now they realize that the welfare state in Europe is really bloated. We talked about that, more capitalistic type reforms. In Germany, they even compensate mothers for years of not working and raising kids. That's a real kind of socialistic thing to do. So the Younger Union sees this as all very wrong, and they're demanding reform. And we're seeing this in other countries in Europe as well. So a lot of things are changing over there also. When we go too far with socialistic policies and they realize it's not getting anywhere and the incentives are all gone and we're just wasting money, and that's kind of what they figured out. In the 1960s in America, there were 6 taxpayers for every 1 pensioner. Now it's 2 to 1. So it's really kind of crazy. In America, There were 7 million folks on food stamps back in 1980. There's 41 million now on food stamps. So a lot of that socialist stuff has seeped into America as well. And so our hope is that they kind of reverse some of those things, get people back to work, give people the right incentive, and that'll help business, it'll help growth, it'll help growth in Europe, it'll help growth in America, and all that. So all these things are affecting the markets, earnings, and the economy. So as long as these kind of reforms are the direction they're moving in, we see very positive things for Europe and America, which are the two, North America, the two major growth areas of the economy, or the major areas of the economy, and then growth is in other continents as well. So, Chris, all that kind of bundles together into a voting mechanism every day in the stock market. We either buy or sell. If we're optimistic, we buy. If we're pessimistic, we sell. But most folks have been optimistic this year. The markets are rising. We don't have a single sector that's down, like you said. So maybe positive things are coming, certainly positive things for America and for Europe. So that's what we hope. Now, what are we doing about it at FourStar? And Chris, you and I manage the FourStar protection plan. We've seen a little sloppiness in the technology stocks and the S&P related names. So we've actually gone to position number 1 on our protection plan, but that was a couple weeks ago. We're not seeing much more movement downward, are we, Chris?
No, we went to that position 1 and it's kind of held there. And a lot of that's just, with the recent volatility, as I said, we've had volatility, the upside and downside. So we're at that kind of first stage of protection, just, to keep an eye, make sure we're kind of helping to protect if we do continue to kind of have that downward slide. But we haven't moved, further or retrenched further from a defensive standpoint. We've kind of halted there. And, depending on how these weeks shake out and this week and next week, maybe we move back into fully invested, which we've done before.
Yeah. Well, and for those folks who have been listening to these podcasts for a while, know about this four-star protection plan to reduce volatility in bad markets. We've only gone to a maximum cash level 8 times in 31 years. And there are 4 positions to go from fully invested all the way to maximum cash levels. And the maximum cash levels are different on different accounts. So we'll often go to position 1, 2, or 3, and then not go all the way to position number 4. So about half the time when we start adding protection, we don't go all the way and we turn around and go back up and get in. And that may be happening now, Chris. We'll see. It looks a little more like that now, but we'll wait till we see the indicators change. And then about half the time we do start raising cash and getting protective, we do go to maximum cash. And we did that in April. We did that a week before Trump's Liberation Day when the markets went down 11%. So it protected our clients very, very well. We don't see anything like that on the horizon right now. And we're hoping that the markets get better, the economy gets better, and then we can turn around and get our protection position off and get fully invested. So that's where we stand as of today. And then all the other areas, international stocks, dividend stocks, those areas we're fully invested and we haven't seen a protection move there at all. So, Chris, I wanted to point out, and folks can see this on the FourStar website, FourStar was named to Newsweek's top firms in America list. So we're very, very proud of that. And so that's out there. Have a look. And you can also go on to the leadership matrix and the blogs on our site. Plenty of interesting articles about the economy that we issue. And those who are on our list and you want to get on our list, you can get copies of those articles as they come out. Things that we see that are interesting. And for someone who's watching the economy, you might want to care about it. Also, Chris, we're going to do 2 podcast interviews, and we're going to talk about the economies of South America and Africa, 2 continents that we visited this year. I've been on 6 continents this year so far, and Australia is the last one I haven't been to. We actually did tape an episode partially from Antarctica. We were trying to tape in South America and Africa, but we couldn't do it. But we do have the notes, and we're going to talk all about what's going on in those economies as well. And there's positive things in all of them. So watch for that episode. We're also going to be doing a number of interviews as well. So we'll look forward to some really interesting episodes as we near the holidays here and then go into the new year. So, Chris, I think that's all we have for today.
Yeah, I think that about covers it.
All right. Well, thanks everybody for being with us. Again, if you can give us a 5 out of 5 ranking on Apple iTunes, that'll help our numbers. We hope you all have a great holiday season. We might check in one more time before then, but in case we don't, happy holidays to everybody. And that's all for today. We'll be back with another great episode of today's Market Explained shortly. Bye-bye now.
Thanks, everyone.
Bye, everybody.